Okay, hello everyone. This is Kevin Hurley. I am the managing partner and founder of Hurley Investments. I have been asked if I would share a little bit about my insurance strategy, why it's done so well for people through the 2008s or even last year in the pullbacks that we've had. So welcome to the Ultimate Portfolio Insurance Strategy. I want to go over collar trading and what the Hurley Investments firm does for its clientele, and I hope to teach you a little bit and help you understand why this is going to be so important for all of us to have our retirement portfolios or any portfolio protected for that reason. I don't know about you, but 2008 scared me. It scared me a lot. When I see a year like I'm showing you on this chart here for 2014, where the Dow was up roughly 7.5%, it actually was a little bit more than that. But when I see a chart that looks like this, I think to myself, money in the bank. I am so excited because this tells me I've got a great opportunity to make some great returns. Yet as I've talked to potential clients, as I've talked to people at the Money Show, other professionals in the industry, I hear a significantly different story. In fact, I actually hear, when I look at a chart like this and I see how good the clientele has done, when I see how good I've done personally, I hear from other people what a bummer year it was, how tough it was. And I hear horrific stories where these red arrows come in on where people got out, and literally they got out way down at the bottom of these red arrows and missed all this moving back up, where certain funds cashed in, rebalanced, and missed all the upturn back, and every single one of these red arrows is a booked loss. I can't tell you how many people that I've talked to that lost money in 2014. And what I'm going to call significant amounts, double-digit losses as a percentage basis on their portfolio. And I scratch my head because I know it's so difficult to trade in today's market, how so many people are worried about 2008. In fact, in all honesty, guys, every fund that you're in, whether it's a mutual fund, whether it's a hedge fund, a managed fund, a pairs trading fund, whatever you're in, understand every fund has emotion in it. There is a money manager or a fund manager that is choosing when to rebalance. And really, guys, the biggest concern is we all know we're due for another big correction or pullback in our stock market. One that should probably make 2008 look mild compared to how much debt the country's in, the risk at losing a reserve currency status. The future looks actually pretty bleak for the U.S. economy and the U.S. stock market. Everyone's going to try to make sure we get ahead of that. So any one of these pullbacks, you see a lot of rebalancing in portfolios, a lot of rebalancing in mutual funds of some kind to try to protect the investor. And unfortunately, in a year like 2014, it ends up being a double-digit loss when it could have been a high single-digit gain. What do we do different? What's this insurance thing that we do? Hurley Investment clients, we buy insurance on our stock, our ETFs, our indexes. We protect what we get ourselves into. That's probably the best way to put it. We're going to protect what we get ourselves into it. We buy a long put option. It's a contract, an insurance contract you purchase, which gives you the right to sell a stock at a fixed price for a set period of time. We have the right to sell our stock at a certain price for a certain period of time, and the neat thing is it doesn't matter what the price of the stock does. If our stock went down, lost half its value, we'd still have the right to sell it way up higher. This long put acts in inverse, or I guess a better way to probably say that is this long put gains value as the stock price goes down. If you bought a $100 stock and went down to $50, that long put would gain $50 of value. It doesn't offset penny for penny, but sometimes it does. Sometimes it might only make up 75, 80, 90% of the downward movement, but anything we make up on the way down is profit when stocks come back up. Long puts can be used just like an insurance policy, but you're using it on your stock ownership, your retirement accounts, or your trading accounts. To give you a general idea and explain how this is so important, guys, we insure our home, our health, sometimes our car or our life. The reality is, why don't we insure our retirement? We insure everything we can to get to retirement, but we don't insure or protect the one thing that makes or breaks our retirement, and that's the income we'll have at that time. I'm going to introduce you to Pandora. Pandora is a great stock that was really supposed to go up to $75. A lot of the hedge fund or the money manager gurus expected this one to be the next Apple. It was at a great price here at the $25 to $29 range. Everyone thought it'd go up to 75. It'd be a good 100% return. People were piling in. There were huge amounts of institutional traders or big money that was piling into the stock at this time. I didn't quite get in as quickly as I should. I got in at $25 a share. It cost $7,500. That was okay with me because as you look at that black arrow, it got up to 20. In fact, it got up to 29. I got in about a week and a half, 2 weeks earlier than that black arrow. I watched my stock go from $25 up to $29. Now, if I had just been like everyone else and just purchased those shares of stock, boy, you look at that big down arrow, it goes all the way down to below $16 a share. At this time period, I took the picture. Pandora was trading around $17.50. That initial $300, if I was just like everyone else, would have taken a $2,250 loss. What happens when this occurs? Well, you might call your broker and he mysteriously never gets your phone call. He never calls you back. Sometimes if you can pin him down, the standard term that they're going to tell you is, don't worry, you're an investment trader, it's going to come back. Boy, I can't remember how many times I heard that from, 99 all the way to 2013 when the S&P 500 took 13 years to get back to where it was. I still don't think Microsoft or Cisco is back where they traded at their highs. My fear, guys, in all reality, is sometimes things don't come back. Boy, if you're in the NASDAQ, you could go back to the NASDAQ when it's trading at 5,100. I'm pretty sure it's been 15, 16 years since the NASDAQ has come back. Guys, you and I can't afford to wait. Our retirement doesn't magically wait for stock markets to come back. Our living expenses don't magically wait for us to have a profit in the stock market. Thank goodness we don't just sit in these positions. We added those insurance contracts all the way up at $29 a share. Pretty good price because as earnings came, Pandora had a pretty significant drop. Again, if we had just stayed in it, we would have basically had a $2,250 loss. Probably I'd have people calling me saying, get me out, get me out, get me out. But because we added protection, I got to make up all of that downward movement. In fact, my insurance contracts were worth $3,450. I'm now able to do something very strategic and very helpful in the stock market. I now have $3,450 that I can add or buy more shares of stock. Guys, dollar cost averaging is a great way to lower cost basis. But I don't know about you, I hate hearing or having to get that phone call or call someone and say, by the way, we just put $7,500 into a stock that's supposed to go up to 75, but I now need you to go put another $3,500 in your account so I can buy another couple hundred shares of a stock that just went from, 29 down to 16. But don't worry, it's going to come back. But please go put more money in your trading account so I can buy more shares. I love getting to dollar cost average for my clientele without ever having to ask them to put another penny into their account. I got to buy another 200 shares of stock. I got to dollar cost average and lower their cost basis down significantly on that 300 shares. In fact, on the way down, when it was all said and done, we actually were up a little bit on a stock that literally just lost 30% of its value. Why is this so important that I'm able to dollar cost average for the clientele? Same Pandora, everything stays the same. Look at what happens now if Pandora gets up to $20 a share. If it gets up to $20 a share, I will have a 33% return on a stock that I got in it up at 25. A stock that's down 25%, my clientele is going to be up 33%. What if it gets back up to where we bought it at 25? Well, everyone else got into Pandora. When we did, they're getting out. They're getting out, oh, thank goodness I broke even. I've just been in the thing for a year, but I didn't lose any money. Well, if my clientele wanted to get out at 25, we're going to book a 66% return. We're going to be profitable 66% on a stock that just came back up to where we bought in our original 300 shares at. And to take this one step farther, we're all greedy. I want to wait till it gets back up to 29. I want to make a little something. For those that got in at 25, they wait till it gets back to 29. A lot of heartache, a lot of worry in that position, a lot of worry when it's down at 16. Well, they're going to book $4 a share. Almost 20% return. Whereas my clientele, if we wait till it gets up to 29, we're going to book a 93% return. We're going to go ahead and we're going to almost make 100% return on a stock that's only moved $4 higher than when we bought in at. I hope you can see the power of trading this way. If you don't mind, I want to show you one more example. I had someone that wanted me to get them into JCPenney. And boy, they'd been in and out, but they said, Kevin, go get me 300 shares at $14.50 a share. As much as I want to talk people out of doing some things that probably aren't in their best interest, I still have to abide by what the client says. You know what? Got in at $14.50. I should say he got in. And at least he listened to a suggestion, said, you know what? Go ahead and double up on those insurance contracts. There's a little something else I could tell you on how he's paying for these. He's going out in time. He's going to be obligated to sell a stock at a profit, and he's taking in a big chunk of change. I said, just please, nothing looks right for this earnings event. Go ahead and double up on your insurance. Just overprotect yourself. Thank goodness we did that, because that stock fell all the way down to $6.50. Remember when I showed you on Pandora? Good news is stock fell significantly. We're okay with that. We're more than okay with that, actually, because as we got these technical crossovers, we didn't get at the bottom at $6 or $6.50, but as it got back up to the $8 range, we got some technical indicators that said, hey, the stock should go higher. That insurance that we got, those long puts, those insurance contracts, boy, they're now worth $6.50 a share. Because we doubled up on them, their total's $3,900. At $8 a share, we got to add 400 shares. More shares than that original 300 that they got in at. We got to add 400 more shares of stock. 100% completely paid for by the insurance. It is so much fun to let people know that they're in a risk-free trade like he was on this trade. Now, of course, we expected it to get all the way back up to 14, but in real life, it only got up to its next earnings event, and look at this sucker fall back down again. 700 shares fell all the way back down. But thank goodness we had insurance, a new set of insurance contracts at $9 a share. What did that mean for the account? Well, we got to pick up another couple hundred shares. No, I didn't get it way down at $5. I'd love to tell you we get the tops and bottoms, but that never happens in real life. Your fund managers don't ever get exact bottoms and tops. But I got to add another 200 shares here. He just tripled his stock ownership. And at no time did Hurley Investments give a call and say, hey, I need you to go add more money to your account. As we jump up ahead to where this ends here in September, I want you to take a quick look at that box up on the top. That 300 shares is now 900 shares, trading at roughly $10 a share for $9,000. We have a net profit in the account of $4,650, or 107% growth in 12 months on a stock that's lost 35% of its value numerous times. A stock that is currently down 27.5% from where we bought it at. We've been able to produce 100% return on a client that had to be in JCPenney's. As you guys continue to look at this chart, boy, you'll see they've fallen back down even more. He's still in great shape. Guys, I hope this is a little insight into what a money manager can do for you. Here's our phone number. Go ahead and give us a toll-free call at 888-287-1030. We would love to spend some time with you. If you have a registered investment advisor representative out there that's already talked to you, give them a call. Give them a call so you guys can sit down and talk about what this can mean for your portfolio. You can reach us on the blog site, My Hurley Investment. You can also reach us via email at customerservice@hurleyinvestments.com. Grab me on my Twitter link, at KM Hurley. I love to send out trades. I love to send out updates to the clientele. I would love to have you start to follow what we do so that if this is something you're interested in, please let us start to help you ensure your retirement. I appreciate your time today. Thanks for being with us. Look forward to hearing from you in the near future, and have a wonderful day. Bye-bye.